it is 4 o'clock. We're going to go ahead and get started. We are going to be recording this. We'll send this out tomorrow or Saturday, the recording, and we'll post it on our socials. But thanks everybody for joining. I'm sure there's still going to be some people coming in, but 4 o'clock right on the dot. We're going to get started. Should be, I don't know how long this is going to take today. Hopefully, I won't ramble on too much, but things are looking pretty good. So, big picture, we're going to talk stock market, economy, earnings, global markets, breaking out of bases, and go through some what ifs. So, today's January 29th, 2026. This is our 2026 Outlook report and webinar. Thank y'all for joining today. I'm Jim Denholm, founder and CEO of Ironbridge Private Wealth. And let's dig into it. We've got a Q&A, so just to kind of set the table real quick. If you look at the little commands across the bottom or wherever it is, there's a Q&A button on there. You might have to click the more, little three dots where it says more. You go to the Q&A. We're recording this live, so feel free to type in your questions there as we get it. I think those are the most important things to do is answer your questions. If you're thinking about it, I'm sure others are thinking about it as well. So please don't hesitate to get into that Q&A and start firing away questions, and we'll get to it at the appropriate time, and sooner rather than later. So looking at the overview, first, going to start off with big picture. Economy is good. Stock markets are good. Commodity markets are good. Earnings are good. And it feels bad. That's basically kind of sums up what's happening. We'll go through each one of these. But looking over here to the right, positives and negatives. The economy, GDP forecasts look really strong. The GDP now, we've got this in a few slides, over 5% GDP, current GDP growth. That's probably going to get revised down a little bit, but that's real growth. So the economy's in good shape. Tariffs are not causing problems right now. Looking at the projected effect of tariffs, if there are going to be effects from it, we're probably going to see it this year and into next year. But they're just really not causing many problems at all at this point. And we've got very strong earnings projected for 2026 that we'll go over. Negatives, I think one of the big negatives that is not immediate, but it's something that we're going to have to keep our eye on. As AI really gets implemented, there is negatives from an employment standpoint, an unemployment standpoint, where I think we're going to see a disconnect between unemployment levels and economic output because productivity could increase so much. We're not going to dig into that too much today. That's going to be a longer term theme that I think we need to keep our eyes on. Stock market, we've got new highs everywhere and it feels bad. That is a really, really, really good setup. That's a wall of worry. When you have good prices, good, strong momentum, strong trends, and it feels bad, that is a really, really, really good scenario. So the negative is that it feels bad, but that's also a positive because it feels bad. Commodities, gold and silver, if you've watched anything, it's insane. There are some interesting reasons why, and it could be good. We'll talk about it. Risks, I think the big risks for 2026, we're not going to get into this too much today, but I do think we are going to have some dedicated reports and dedicated webinars to this. The corruption I think we're just scratching the surface. Part of the wall of worry, one of the big risks I think this year for an average investor is an emotional mistake. It doesn't feel good, but the data looks good. That's an easy way to sell and miss out. So, I think the one of the key themes for this year, it's sort of our theme in general, but it's data over emotions. We really need to look at the data because I think our emotions in this later market cycle are going to be challenging, I think. So just kind of watch that. So let's get into some charts. Stock market is good. This is the S&P 500 index going back to December of 24. So, a year and a half or so. This was the tariff scare last March, April. Sort of had a normal pullback. Then we had a big sell off, 12, 13% in, a few days. We had volatility overrides. We had, looking at active management, we had a little bit more risk in our portfolios and Ironbridge portfolios than we would normally expect with this kind of pullback, but we did get a lot of volatility overrides that prevented us from selling. That was a good move. We got in this panic situation down here and we've back tested it. It does not make sense to sell. And that proved to be correct. So we've seen this move from those April lows that have really been low volatility. Every little dip is getting bought. This is the biggest pullback that we've seen since April, and it was about a 6% pullback. On average, we should see a 10% pullback once or twice a year. So we're a little overdue for something bigger. Maybe we're starting that, but the fact is, when we see these little wiggles and every little sell off is getting bought, that's a sign that that investors are underinvested. There's a lot of cash on the sidelines, and they're coming in and picking it up. At some point, this could roll over, but until we really start getting some risks, new all-time highs are the definition of a bull market. You always want to have new all-time highs. We added in these orange lines here. We have a risk managed index strategy as part of the overall portfolio. It's 5 to 10%, depending on the strategy of an overall allocation. These orange lines just show part of the trend strategy that we use. It's one of the ways. It's called a pivot point. It's the previous month's high-low close. Nothing magic. Our system, if we go close 2 days below, it's a sell. 2 days below or 2 days above closing, consecutive days closing above it, it's a buy. We had volatility overrides, so we had held on to SPY pretty much through this whole move, which was the right thing. And you can see that I think of this as a stop loss. As the market starts going up in this particular strategy, we use these pivot points as stop losses. And so as the market trends higher, which is that exit stop loss gets a little bit higher every single month. And at some point it'll roll over and, we'll hopefully be out if and when it does go into the next cycle. But right now we've got new all-time highs and that is bullish. It's not just tech also. It is kind of everywhere. Economy, this is the Atlanta GDP estimate, 5.4%. I did see a estimate of what this might come out, maybe a little above four this week. That's still really strong, especially when we're looking at blue chip consensus estimates of being below 1%. I mean, the estimates are just so far removed from reality, and it really has been the big bank blue chip analysts have really been poor over the last year, and it looks like they're continuing that track record. But we've got nice positive growth happening in the economy. So GDP looks good. Earnings look good. So kind of a busy chart. I'll just kind of look over here to the right. We're looking at earnings for not just US, but outside the US. S&P earnings projections for 2026 are about 14.7%, which is nice. That's good growth. We're seeing this accelerate, which is also positive. When we look at emerging markets and developed markets, emerging markets with 23%, this is the Morgan Stanley International Index. There's some other ones with EEM, and depending on the composition of the emerging markets, there's some earnings growth that are projecting up to 35% for 2026. Those are really good numbers. Small caps, mid caps in the US are also kind of 25 to 35% projected earnings growth this year, with large caps being 14, 15. Those are really, really, really nice earnings growth. And when you saw this kind of acceleration previously, that was also pretty good for stocks. So it really is looks like we're getting into kind of the meat of the bull market, or we're kind of been in the meaty part of the bull market where it doesn't feel good, but it's just this grind higher in the markets, and that's actually a good thing. So this is a good thing to watch for sure. Drilling down into the S&P 500, this chart looks at the sector projected revenue growth within the S&P 500 for 26. Technology, materials, industrials, the cyclical areas are really, really showing good strength. This is exactly what we'd like to see. We want to see the more defensive areas, consumer staples, healthcare. Real estate's kind of its own deal over the last maybe 5 or 10 years, but we're seeing the aggressive areas of the market do well both in the stock performance and in these earnings growth. So 14.7, 15% earnings growth overall. We're looking at 28, 29 in tech. I think this earnings growth may slow down. I think one of the things that we're going to need to start looking more of is profitability. One the with the adoption of AI, productivity should increase quite dramatically. Unemployment could increase over time. I don't think it's going to be quickly, but it's where I think we're going to have a consistent replacement of human capital with AI. That could be really good for the market. If you look at banks, for example, Wells Fargo, a company that most of our team used to work at one point, they've got 200 and I don't know 20, 230,000 employees. Probably half of those are worthless. If you look at the projected, not necessarily the projected revenue growth, but if you look at the projected profitability, if you can get the headcount for a lot of these companies down by just automating menial tasks, you've got an earnings expansion and a multiple expansion that could happen in the more defensive areas from profit margins increasing. So looking forward, when we've got good earnings growth, that's positive. If we can get good earnings growth combined with good productivity growth, that really change that is a potentially a fantastic investing environment. So AI is going to have it's going to be messy and it's different. It's not all going to be bad, and unemployment is not the only thing that we need to be looking at. So revenue growth is good. We're also going to be talking about productivity throughout the year, and I think in the years to come. Global markets are good. So we got six charts here. S&P 500, mid cap, small cap, Bloomberg Commodity Index, emerging markets, or international stocks, the ticker VEU. If you look, you can see at the S&P, it's felt kind of bad over the last few months, only because it just hasn't really gone anywhere. We've kind of been in this 6,800 level really since October. So we're going on 3, 4 months of really a sideways consolidation in the large cap, which is exactly what's happening in tech. So the S&P is really mirroring tech right now. When you look at the others, you can see in this November timeframe when we had this little 6% pullback or so, S&P just flattened out. Mid caps, higher by 12, 13%. Small caps higher by 15%. Commodities, 20%. Emerging markets, same. International stocks. So we're seeing this real broadening out of this rally. What happened, we're year three of a bull market. It's been heavily weighted in tech. Tech is holding up, but consolidating sideways while all these other areas start pushing forward. That's a broadening out of the rally. That's a normal occurrence that happens in the meat of a bull market. And it's exactly what we're seeing right now. So, so far, this is looking pretty good. The difference is you have to think about your exposures differently. It's not just US international bonds. There's other stuff that we're going to need to invest in, and I think that's also going to be a theme over the coming years. But it's not just the US that are making new highs. Some random ones that are making new highs, small cap value that has been left in the dust for the last 5, 10 years. It's breaking a new all-time highs. European banks, which could be the biggest dog on the planet, just dead man walking, they're pushing a new all-time highs. So, there's something else going on here. And it's not necessarily all that negative. But when we see this kind of coordinated push higher outside of the S&P and starting to see the more aggressive areas of the market outperform the S&P, that's a really good sign. So it's just a sign that things are good. Looking at uptrends, not going to spend a lot of time on this chart. S&P 500, what this looks at, this bottom chart is basically looking at the 7 major areas in equity markets around the globe and how many of those 7 are above their 200-day moving average. So it's the current price higher than the average price of the last 200 days. So that just basically tells you that the price today is higher than that average. That should be an uptrend. And we've been that way really for, I don't know, 9 months, with some little dips here, but it's a strong market. Another thing that's good, breaking from bases. This is a very, very powerful development in markets. Here's emerging markets. The ticker is EEM, very kind of the most widely accepted or used emerging markets ETF. It had peaked in 2007, kind of mid 2008, and it didn't get back above it until now. That's a 17, almost an 18-year base. There's been accumulation. You see a higher lows. There hasn't been higher highs, but it's a consolidation where it's been testing this area multiple times throughout the last 2 decades. But when there's been sell-offs, the sell-offs have been higher. So there's been this sort of stealth move under the surface suggesting that at some point emerging markets international stocks could break out. That's exactly what we're seeing. And this is a pretty decisive breakout. It has the same sort of pattern as this big push higher and then it just sells off. Big push higher, sells off. This right here, there was not a lot of previous history here. We're in price discovery mode. But now we've got multiple times where, the market has gone through and tested this area. The overall economy in the emerging markets has grown substantially over this period of time, and the equity markets have not. So this breakout has the potential to be incredibly good. The risk is a reversal or a false breakout. Kind of like here, if we drew a line from this high point over here, market sort of went above, kind of overthrew it, and then immediately or pretty quickly went back down, retested that level, and then it was, went from 56 to 32. So, what is that? Probably 40% or so, 38, 42%, something like that drop. We don't want to sustain that and come in here and be buying right here, and then all of a sudden we see a false breakout and this thing really starts moving lower. So we can't be complacent up here. It's not a slam dunk guarantee. Nothing is ever a guarantee in markets. But when you see this kind of move over such a long base, over such a long period of time, that should be positive. So I do think emerging markets international, there's a very good chance that they're going to outperform the S&P this year and maybe for 10 years. A lot could be a long time. Another breaking from base is the Russell 2000. Mid caps look the same, didn't show that, but this looks back to 2021. So here was there's a little bear market in 2018, COVID. and we busted higher, sort of stalled at this 230, 240 level, came back down and tested the highs from 18 and 1920, just sort of bounced around the bottom of the bear market in 22, 23 into 24. And then it started to play catch up. We had this, this has had a little more volatility than the S&P because it doesn't have as much tech, but it has really skyrocketed. Same sort of thing, this had a breakout. We almost had a false breakout here, and then it had a false breakout, and then a breakdown and a false breakdown. So, it can get whippy in here, but typically these aren't super clean. So it wouldn't surprise me. We've had some nice activity around here, but this is a very decisive break. We've had some retests here, so it has sort of tested it. Maybe it wants to go down and retest it at some point over a more sustained amount of time. But outside of that, I think this probably should push higher. Um, Looks like we've got a question I just saw. Okay, let's take a little pause. Consumer spending is 70% of the economy. If AI materially impacts employment, company efficient profitability go up, but wouldn't you anticipate consumer spending to get crushed? Great question. This is where the government corruption comes in. I'm not going to veer off track. We're going to talk about this a little bit. I think part of the plan is that we're going to see a universal basic income. And I think that's going to answer it. I think it's probably going to be a high universal basic income, but I think there's been so much fraud in a lot of the benefits that the increased unemployment, what the US has been doing is basically have unemployment be a government worker. No offense to government workers, but a lot of the jobs in the government sector were an unemployment benefit, in my opinion. This is my personal opinion when it comes to government stuff. But I think what we're going to see, I think yes, there is with consumer spending being such a big part of it. I do think that there is risk of the economy breaking down because of consumer spending going down. But I do think that I think that it might be a similar size pie, maybe a slightly smaller pie of economic output, but a much more profitable pie. So I think there's going to be a universal basic income would be my answer to that, but to be determined. But that's a really good question and something that could definitely throw things off. So tech, let's look at tech versus the S&P 500. Kind of said, it's sort of paused here. So this is XLK, the tech sector ETF relative to the S&P 500. So an up move is XLK moving higher faster than SPY. So outperforming SPY on the upside. When this line goes down, that means XLK is losing more than SPY. So the tech stocks are going down faster than the broad market, going up faster than the broad market, down faster, up faster, a little down faster. But it's kind of sideways. So, we've seen the S&P sort of stall for a few months. It's this tech. It's XLK. This is, 36% roughly of the S&P 500. It's by far the biggest exposure. All tech is not equal. Semiconductors, they're pushing to new all-time highs. We've seen software lag. Microsoft had earnings today. We had a big position in Microsoft, sort of whittled it back a few times over the last few months. And I mean, it was down 12% today. So we're seeing software be pretty weak right now, but semiconductors, robotics, a lot of the AI stuff is doing just fine, and we're not seeing any relative breakdowns. So given the fact that the semiconductors relative to the S&P look very similar, we had this, kind of peaked out here, broke above, retest, a little choppy around it, and now it's accelerating higher. XLK could easily do that. Little bit ironic because today we had an XLK sell in favor of materials, but if tech stocks does come back and really starts dominating the S&P, then we'll move back into it. We still have small cap technology though. So that not all tech is consolidating. We're starting to see this dispersion, starting to see things perform differently. PE ratios. One of the risks I've heard both from clients and on news and stuff is, are we in a bubble? Valuations are kind of extended. If we look at PE ratios and the velocity acceleration of PE ratios, we're not anywhere near bubble territory. Elevated, yes. The valuations are not cheap by any means. So we have to factor this in. But I think the market is starting to expect that the profitability and the earning side of it is going to, man, keep the PE ratio sort of stable and not have P go way above the E and have this PE ratio get into 60, 70, 80 like it was in the tech bubble. We've seen that happen with individual stocks. Nvidia got up to 80, 90 PE ratio, and the market was expecting the explosive growth in earnings. So not all PE ratios are high PE ratios are bad. They're not all good either, but they're not all bad. So we need to watch to see if these PEs get really start to blow out. But I think the bubble risk is just not there, at least not now. Again, valuations, if we look sort of across the globe at what PEs look like, we don't use PEs as a input for action, but it is good to just understand the context. And if we look, how this works is the mid quarter was the range, kind of average range, the median at this little orange sort of mustard colored dot, whatever color that is. Current is the green diamond, and then the 10th to 90th percentile. So this is the 10th percentile, PE of 11, 90th percentile, right at 19 and a half, 20, and we're at 22. So we're above, so it's like I say, it's not, we can't ignore it, but this is not a chance to just sell everything in the US either. I do think it's an opportunity to selectively reduce US and selectively increase international. But if we look, China, forget about the UK, emerging markets, and AC, the all country index world ex US. This includes US, so that's going to be much higher. Ex US, emerging markets, China, 12, 13, 14, 15. Those are great PE ratios to invest in, especially after a market that's hasn't done anything for almost 20 years. Valuation. So this is a chart that we shared before. Valuations are not good timing tools. It this still surprises me. This is from Ryan Dietrich, one of my favorite. He's a friend of mine, one of my favorite guys to follow at Carson Research. Um, Basically, what this shows is the current PE ratio on one axis, on the Y axis up and down, and the 1 year forward performance. So the performance 1 year later on the X axis. This black line right here is the scatter line uh, retrofit chart or line. I'm blanking on what it's called, but basically it just says there's not any kind of correlation. There's no correlation between PE ratios and future 1 year returns. All of the talk on CNBC, all of the talk on every single research report about PE ratio, PE ratio, PE ratio, the data does not, it suggests that it does not matter. I mean, if we look at the highest PE ratios, they're even skewed a little bit positive. You look at 35, if it's above 35, maybe it's even. You've got one, two, three, four, five, one, two, three, four, five. You kind of go down to maybe 30 and you pick up a whole bunch out here. We're at what, 23? It's skewed out to the right. So, more positive returns at this current PE level than negative returns. So, when you hear people say, oh, well, it's just too expensive, we need to sell, you can arm them and say, actually, statistically speaking, there's not a correlation. So, give you a little dinner party talk, and I hope you're going to more fun dinner parties than that. So what's happening with all this stuff? We're going to get to gold and silver. Why is this happening? Well, the dollar is really wagging the dog. It's kind of the tail that's wagging the dog right now. There's a lot of different influences on the US dollar, but when we look at commodities and we look at international, let's just kind of focus on those two when we look at the US dollar index. Those two very much benefit from a declining US dollar. The purchasing power of a foreign country can go up when the dollar declines, and a dollar devaluation, all that means it's down in price. It goes down. So when a foreign currency goes up relative to US dollar, that's better purchasing power. So if money moves from the US dollar into the Chinese yuan or the Japanese yen or a euro or whatever, and it gets invested there, if that currency appreciates, there's an additional return that you can get if you're doing some currency hedging. Well, as this dollar, and you can kind of see that what this shows is the US dollar index, which is the US dollar against a basket of currencies. When this goes up, and this is from All Star Charts, they're nice technical group. I really like those guys. When the dollar is declining up, this looks at international stocks outside of the U.S., not including any U.S. stocks, ex-U.S. versus the U.S. So as this bottom line goes down, U.S. is outperforming international. So as the dollar goes up, international performs worse relative to the US. Make sense? Dollar strengthens, international does bad. Dollar weakens, international does good on a relative basis. Dollar strengthens, international does bad on a relative basis. We're starting to see this break down. This move right here from the peak a few years ago, 2 or 3 years ago, this has driven gold, the price of gold. It's driven the price of silver. There's some other factors going in with that too, but this is a big one that started it. The fact that we're kind of breaking down and this relative move of US over international is breaking higher, these cycles tend to be big cycles. This doesn't look like a real long chart because we've been dealing with kind of 1 year charts. This goes back to the financial crisis. So this is that almost 20-year chart that we're talking about. So 20 years where US has absolutely dominated performance could be changing. All of the S&P 500 index funds out there, all of the heavy US exposure that most US investors have, like in their 401k plans and things like that. That's something this year that we're going to need to start reallocating out of and start shifting around that exposure in stuff that we're not actively managing, to push that international stocks a little bit more and get exposure there. So there really is some good upside that could really happen. We've seen it in the metals for sure. I think we're in a commodity bull cycle, but the dollar is gonna drive a lot of it. Looks like we've got another question. 2014, when the dollar was really strong, U.S. companies went on a buying spree of international companies. Do you expect to see that happen in reverse? And could that be helpful for domestic small and medium caps? I don't know if we're going to see acquisitions. I think we could see that as the trend matures. Um, but you could. I think small and mid have upside potential, not necessarily because of international acquisition strategies. Tariffs help. When you look at small and mid caps and the more local companies, I do think that there's going to be the a hidden benefit of tariffs. And I'm not a always Trump, never Trump. I just don't like any of them. I think they should all go to jail, and I'm so tired of all of them. So that's just as an aside. Um, but I do think that part of the tariff consequences could be small and mid cap companies being able to compete with large cap companies. When you can offshore, when you're a like Iron Bridge is a bad example because we don't manufacture stuff, but maybe Yeti when it was just starting out. It had to go like their story is pretty cool, but they had to go over international and find materials and labor and all that stuff. If you're a starting out company and you don't have big investors, that's tough to do. So when you start to put some fences around the economic boundary, small and mid cap companies were hurt. The mom and pops were hurt when NAFTA happened, and you start to get the free trade. The labor markets hurt, and it hurt the small and medium sized companies. That could reverse. Doesn't mean it's gonna necessarily do it, but I think that's part of where the mid cap and small cap companies are starting to exert some relative outperformance over the US is because they don't have the tough decision of where should they should they hire locally? Should they expand internationally? What do the shipping costs look like? What do tariffs look like? What do currency moves look like? You have all those kind of issues when you're dealing outside the borders. And really, up until this point, as you can see with this, it just there hasn't been a competitive advantage. It's been a competitive disadvantage for smaller companies within the US to compete with the bigger counterparts, especially when it's more profitable to go outside the US for materials or labor. So I think that is a little bit more consequential to the small cap and mid cap, but we could easily see have some international companies come in, especially if the tariffs are there. We absolutely could see some wanting to get access to the markets by buying some smaller, medium, even bigger companies. So another good question. We've got some good questions today. So dollar index, looking at this another way, this is a little bit technical. I'm not going to spend a lot of time on this, but this just looks at the dollar positioning. One of the reasons I wanted to look at this is if we've got extreme moves in one way or another. It could say, well, the dollar's exhausted. It's the positioning is very extreme. So we saw really, really heavy long exposure betting that the dollar is going to go up. You typically see that happen at extremes. So everybody's all in. You lose the incremental buyer, and then sellers show up and you get the price to go down. Happens in inverse. So as you get lopsided short positions, people kind of betting that the dollar is going to decline relative to other currencies, you tend to get lose the incremental seller and you start to get people covering and you get buyers that step in, push the dollar higher. Same thing. This is just how human beings work. This is how markets work. We're idiots in better clothes, cavemen in better clothes. But the same thing here. So I was interested in this positioning. We're neutral. So, we're breaking down here. We're not at some real extreme bearish position like maybe here a couple years ago. So, this tells me that this breakdown, there's been some short covering and we're seeing a breakdown. So we're really not seeing any buyers showing up. So the fact that we're sitting here neutral after sort of covering tells me we could have another leg down. We could easily, go back up and get a bullish move, but it's more breaking down, and I think that's likely to continue. So the fact that we've gone back to neutral positioning says there's really some dry powder to push the dollar lower, and that's what we're starting to see, and it's starting to take out some support levels, which could accelerate the dollar decline and accelerate an asset rally. Hopefully that makes sense. The dollar discussions are kind of weird. Let's get into some fun stuff. Gold and silver. Gold has been nuts. We've been in it, 18, 24 months or so. I mean, it's just been crazy. We've taken some profits recently, just rebalancing. It's gotten so skewed, both in the gold exposure and the gold miners exposure. We took some profits on gold miners today. We took some profits on gold and silver earlier this week, last week. Just to get it back down. It was on Monday. Get it back down to just normal positioning. I still think that there could push higher. We're due for a little bit of a pause. This is a massive move from below 4,000 to above 5,600, gold per ounce. That's a really, really, really big move. It's fun having participated in it. We're going to continue to participate in it. It's starting to broaden out into other commodities, but it would make sense for this thing to chop around. Expect gold and silver to be pretty volatile. So looking at silver, same sort of thing. It's just gone so crazy. Oh, and then where should we? Didn't even talk about the Fibonacci retracement. Sorry about that. So if we do see a pullback, where would be a normal place that we should expect a pullback to happen or to go to? If we look at the start of the move down here last November, we've seen this real big move. It's due for a pause. We haven't really seen any kind of pause. This looks like what's called a spinning top. That would suggest maybe we're going to see a little bit of a period of consolidation. We don't want to get rid of our positions. We do want to right size them. We just took some weighting down, took the allocation down to take some profits, but I would expect this. 5,000 is one of those round numbers. That's the 38% retracement. A shallow retracement typically gets to the 23 to 38. That'd be 5,000 to maybe 5,200. I think we're going to see bigger than that. We kind of touched that even this morning. It was a big range today. I would expect if a sustained rally, I would not be surprised to see gold or silver get down to this 50 to 62% retracement, this Fibonacci retracement. Very, very, very common. This 62% retracement has a high point right here. You're not too far away from the high point here. So maybe there's some gravity in these little areas that we could see a pullback down into the next, week, few weeks, few months. But, at this point, we just have to watch it. It could really sell off from here. I would expect a sell off into this area and sort of reevaluate what happens, because there's also the possibility that the dollar starts to really collapse. We're seeing that in Japan. We're seeing that with the yen. If the dollar really does collapse, gold could double. It could double again or triple again. I think that's a there's other big stuff happening. If that happens, it's a possibility. Silver, same thing. If it wants to correct, had a big sort of spinning top move today, sort of indecisiveness. We haven't seen a move like that in a while. That's tends to be a little bit characteristic of at least an intermediate term top. So, I think there's some risk here. So we don't want to be pushing too hard in here. Again, we've taken profits. I think if we can get down to this 90, 92, but especially if we get into the 50 to 62% retracement, 75 to 83, that's a great buy right there. Probably won't want to, but and again, same sort of thing. If given this, I would expect, probably a 20% drop, but it's moving so much and so fast. You have to kind of keep a position, but new positions, we're going to let this let this sit back for a little bit and hopefully sell off some without hurting that. Good question here. Can you explain what Fibonacci means? Okay, now we're talking my language. Um, Fibonacci, so the Fibonacci sequence is God's ratio. It's all over nature. And all it is, the Fibonacci sequence is the first number is zero, one, and the next one is 0 plus 1 is 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8, 5 plus 8 is 13, 8 plus 13 is 21. That's the Fibonacci sequence. It's essentially a what's called a fractal, and it allows similar patterns to happen on different scales, either in time or price or space with a flower or things like that. So it's a little bit gypsy, if you will. Fibonacci ratios are not in our rules, but it is fun to look at. So and they tend to work. I don't know if it works because of our human brain or if it works because people expect it to work. Either way, it tends to work. So we should get down in one of these two or support levels. Question: why are the stock market and gold markets both surging? I thought that normally they were inversely related. Another good question. They historically have been. Usually, when you see gold spike, it's a recession type of a scenario. We're not seeing the economic data suggest that yet. It's kind of the opposite. But with markets, and especially with the advent of technology, if we look kind of like longer term, I'm going to maybe pull up a different chart here and see if, I don't know if y'all can see this. This is a kind of a live version of the silver chart. Um, I'm going to put this in a log chart in a second. This goes back to the 70s. This is what concerns me about silver. This is when Volcker came in and, you know, really busted inflation that had been so bad throughout the 70s decade. And we saw this massive spike because interest rates and recessions. Here was 2008. Actually, in 2008, gold lost as well. So there's kind of talk that it did, but it really didn't. And this spike in 2011, I don't even remember what that was. That just sort of came out of nowhere. Um, but you know, we had both of these spikes that were big moves. And look at this thing. I mean, it gets dwarfed by it. So, you know, there has been some correlation. It's only been back in the late 70s that when Volcker came in and busted things up. But the decade was good too. It was kind of a good decade and it spiked higher. Not dissimilar to this. And this is silver, you know, kind of up the last few years and then this thing. I do think that there are some other things happening. I think that and we're going to talk about this on one of the what ifs. I think there could be some financial system upgrades that's happening that definitely explain this move. But this is the kind of thing that we really need to be careful. You know, this kind of crazy move, just going vertical like that, it could reverse all of it. You know, this reversed all of it. There's a pattern called an Eiffel Tower pattern, and you've got the left side of an Eiffel Tower with a big, giant, huge antenna on the top of it. A lot of times it'll mirror on the other side. So this is not the kind of market that you just want to bury your head in the sand. It's the kind of market and it's the kind of market that can sting either way. It's the kind of market that this thing could double in a month. It's the kind of thing that this thing could go down 70% in a week. So we really have to just make sure we're kind of constantly keeping that exposure at a kind of a logical amount, a logical size enough to really push, to push it on the upside, but not too much that you get a weird gold that's just driving your portfolio. So, and when it goes up so much, like GDX, I mean, for some portfolios, the gold miners were 12% of portfolios that had grown so much. So we're right sizing that and taking profit. So I think this is the kind of environment that it's a fluid situation, and we need to not be complacent for sure for a lot of different reasons. Good questions. Here we are. What ifs? So how are we doing on time? What ifs? What if number one? What if the bull market continues? We're going to go through four. What if it continues? What if we get a bear market? This financial system upgrade and talking about crypto, corruption. We're not going to get into corruption as much as I would like, but I do think that that's going to be something that we have to pay attention to this year. Um, so what happens if it continues? What's going to happen with these asset classes? Equities, we're bullish. This is a bull market. Behave as such. It could change this afternoon. It could change tomorrow. So you can't be complacent. This is a bull market. Large caps are starting to underperform small cap, mid cap, international commodity. Could continue. Typically, if we're going to see this broadening, I would expect it to continue. Bonds, neutral. Those interest rates are going around quite a bit, but we've seen a normalization of the yield curve. So what we've seen over the last year and a half is the Fed has cut 1.5% interest rates on the short end, 150 basis points. The long end of the curve has gone up. So 20-year treasury rates, 30-year treasury rates, 10-year treasury rates, those are all going up. So even though the Fed is decreasing rates, pushing the easing the financial conditions, we're just bonds don't look attractive. It doesn't look attractive. The yield above safe, if we look at what we're in, are very short term, high quality bonds. They're paying about four and a quarter. You go out duration and you take credit risk, you might be getting six. And if you look, so you've got a maybe, let's call it 2% higher return annually. If you look a couple years ago and we saw rates move, the short duration were basically flat, maybe down 1 or 2%. You start taking duration and you're down 20, 30, 40%. You start taking credit risk, even short-term credit risk, you're down 10, 15%. It's not worth the additional 2% of yield. So with bonds, there's not a lot to do in the bond market. In our opinion, the return is just not worth the risk. So short term, stable, clipping coupons. At some point, bonds, I think if interest rates push higher, are going to start making more sense. Commodities are bullish. We've kind of talked through that. Watch the dollar. Crypto, we're going to talk about crypto with this financial system upgrade. I have not liked crypto, but we have use case. And I do think that we need to have exposure to it, and we have been getting exposure to it for our clients. So we'll talk about that more in a second and in the future. But what if, number one, this is what we think is going to happen this year? It should be a good year. We should have enough momentum to get into the second half of this year, if not into 27 with higher prices. Bear market signals, what should we be looking for? We're not seeing it right now, obviously. First warning sign in equities, reversal. We talked about that. If we see these break higher in emerging markets, small caps, mid caps, immediately reverse. That's the first warning sign. That doesn't guarantee that a bear market's going to start. Going back up to this S&P chart, scroll up here. There's been a couple times, like right here, this is where you had a sort of a similar look, like the slope was starting to slow down a little bit, the rate of change was slowing down a little bit. saw pop higher, it reversed, pop higher, reverse. So, there's been a lot of overlap in this market, which is interesting. You don't usually see that in a real strong market, but there has been quite a bit of overlap. So there's been some times where we've had a throw over and it looked like a false breakout, but we didn't make any damaging new low. So, that's the thing to watch for here is if we get a throw over and we get this false breakout where a new all-time high reverses, the levels that we're going to be looking at are these recent lows. So the first level of support is a 6,800 and 6,700, 6,500, whatever these are. This one looks like a bigger one, so we could easily kind of come in this area. We're overdue for a 5 or 10% pullback. That'd put us down testing this support level, about 6,500, 6,300. If we got a 10% pullback, that would be completely normal and would not be concerning at all, but we'd want to keep an eye on. So it's if we start to see some real sustained breakdowns that we could start to see a shift in overall sentiment. So those breakdowns, kind of false breakouts and breakdowns, is kind of number one thing to look at near term. Um, Bonds, going to be jittery. Commodities looking for the reversal. Going to spend a little bit more time on this in the future. Crypto looks like is on pace to start to replace bigger transactional services in the financial system. XRP, Ripple, this is so I'm not going to go through a big explanation on crypto. Essentially, it's the blockchain. It's a way to record transactions that is stored on multiple servers, multiple points of control, and changes can be seen. So it's theoretically more transparent, safer, faster, cheaper. There's been a lot of developments over the last like 6 months in this. And it looks like, for example, the Swift payment system could be replaced by crypto transactions. These are all companies that have partnered with XRP Ripple to do some kind of blockchain within their company, whether that's like Bank of America, ING, Barclays, BBVA, PNC, these big banks are starting to do transactions on the blockchain ledger. The SEC has come out, Securities and Exchange Commission came out a couple weeks ago and said that every transaction that the SEC oversees within 2 years is going to be on a blockchain ledger. The major central banks, like the Fed, has said banks can do whatever they want with crypto. The regulatory hurdles have been dropped. The only last thing is a Clarity Act bill that, I didn't see the news. I was kind of finishing up this presentation. So I don't know if it was voted on today or if it passed, but that's kind of the last one that's keeping this crypto down. So I do think more to come with this year. I do think that there is some major developments that's coming. I don't know how fast that's going to be, but it's going to be a new plumbing that's going to be cheaper and faster. And that's why we've started to build exposure to it. Other thing that I'll mention real quick, the other thing that I'm reading is that you could have a commodity backed cryptocurrency. This would start to explain the move in gold and silver. Ripple, I have read, is going to be backed by gold. Stellar Lumens backed by silver. So if you have a transaction that happens, it's not just this Beanie Baby cryptocurrency thing. There's actually a tie to a real world asset. This really could make things very, 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 very efficient. So more to come on this, but this is why, if you've looked, we are starting to put some crypto in small positions as a hedge, just in case things do change. Last what if, and one more slide after this. I know we're getting right up on the hour. Corruption, I think it's big. Where there's smoke, there's fire. This is what we had said. This is almost the exact slide. I just rearranged it a little bit that we did in our mid-year outlook last summer. I think corruption's going to be exposed. We're seeing that. Just bring the bad actors and punish them. It's not a Republican or Democrat issue. I do think that as this starts to, we're going to talk about this more. I think as this starts to come out, I just think we need to keep a lot of grace and kind of come together over it as opposed to pointing fingers. But I think you should keep an open mind. There's a lot of smoke. I think there's a lot of fire. We're seeing a lot of it, and I think it could be shocking. So it's something that we're going to watch, but it could be really good afterwards. We could be in a situation that there's so much fraud that we see massive reductions in taxes. And Scott Bessent, Trump, multiple people in positions of authority within the administration has said, don't be surprised if you don't have to pay taxes in the future. So I think that they know that there's big corruption, and I think we could legitimately see in the next few years no IRS, to be determined. But I thought this was a great quote. No man who is corrupt, no man who condones corruption in others can possibly do his duty by the community. I think we need to keep that in mind as this stuff gets exposed. So, summary, expectations, it's a bull market. Political risks are growing. We think volatility will increase. It was a pretty low volatility year last year outside of the tariff scare. So we should see increased volatility, but I don't think it's going to be enough to derail the bull market. Our system doesn't care what I think. So I could think it's going to be a bull market for 10 years and we get sells tomorrow. So the key with all this stuff, there's some uncharted territory that we're getting into with corruption, with the financial potential upgrades, with gold and silver moving like they are. There's some weird stuff out there. It becomes really important just to stick with the process, look at data, don't impose your own thoughts on it, and just be very, very, very diligent. I think there's some opportunity over the next few years to really increase your net worth. But there could be some opportunities that you're going to have to avoid having that net worth get a big ding. So I do think we're entering into an environment, not just this year, but going forward, where kind of the passive investing of just go throw it in the S&P 500 and you're going to do great. It's not going to be a bad thing to do, but I don't think it's going to be the best thing to do, which has been the case over the last 10, 15 years. So active management, I do think is important. I think it's going to become much, 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 much more important. I'm not going to go through over every single one here. We kind of talked about it, but doesn't look like we have any more questions. We will kind of wrap this up. If anybody has anything else, don't hesitate. Please reach out to me. Send me an email, jim.denholm@ironbridge360.com. Do a little bit more on Twitter X at denholm_Jim. I do expect, last year we didn't have a lot of reports that we were sending out. It's just kind of a grind higher market, not a lot of volatility. I do expect more smaller reports to be sending out that are kind of topic specific as opposed to big topics covering multiple areas of the market at once. So if you want to hear anything, please reach out, let me know. Any questions on this, please let me know. We appreciate you, appreciate your time, appreciate you listening. We're going to send this out over the next couple days so you can review with the slides, and we'll put it on the YouTube channel. So thank you everybody for joining us, and invest wisely. Have a good day.